The Alt Goes Mainstream podcast is brought to you by Juniper Square. What if managing private equity, venture, and real estate funds could be seamless and scalable? Meet Juniper Square, the fund operations partner to over 2,000 private market GPs worldwide. Juniper Square gives GPs the connected software, data, and fund administration services needed for modern private markets. No matter how ambitious your next raise is, how many investors you manage, and how complex your investment vehicles are, Juniper Square empowers GPs to raise capital faster, reduce operational risk, and deliver a world-class investor experience. And with Juni AI, Juniper Square's enterprise-grade AI built for private markets, GPs can truly and finally unlock the power of AI to work smarter, move faster, and focus on relationships and returns. Scale your business, not your operational burdens and costs. Visit junipersquare.com/AGM today to learn more.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode is about mining for investment success in enterprise software by going, quote, an inch wide and a mile deep with someone who is one of the industry's most prolific private equity technology investors. Nic Humphries is the senior partner and executive chairman of Hg and head of the Saturn fund. Hg, one of the top 10 largest private equity firms globally based on the PEI 300 ranking, has built an impressive investment engine focused on mission-critical enterprise software. The firm has built a portfolio that is a, quote, transatlantic ecosystem of software and services businesses, representing over $180 billion in collective enterprise value across its 55 portfolio companies. Nic is responsible for Hg's strategy, management, and governance. On the investing side, Nic focuses on larger software investments that provide daily use mission-critical applications for accountants, tax and compliance professionals, and designers, engineers, and scientists. He's brought his electrical engineering background to bear to go, quote, a mile deep in a category where Hg has become an unquestioned market leader. Nic balances being both a detail-oriented specialist with a vision for both the enterprise software industry and Hg as a firm. We had a fascinating discussion about enterprise software investing, how to create European software giants, applying AI to make companies more efficient, and much more. We covered the origin story of Hg, how Hg grew into one of the industry's leading software-focused private equity firms, how an engineering mindset helped Nic become a leading investor, why Hg focuses on mission-critical enterprise software and why it's a compelling investment thesis, why enterprise software investing can be considered a low-volatility investment strategy, and how Hg has delivered consistent returns to investors, how to effectively manage exits and DPI, why Europe, why now, and how AI could impact technology and services businesses. Thanks, Nic, for coming on the show to share your wisdom and expertise about enterprise software and private markets.
We're going mainstream.
Nic, welcome to the Alt Goes Mainstream podcast.
Thank you very much indeed. Delighted to be here.
Well, no, thank you for having me in your office here in London, right by Tower Bridge.
For the lovely weather.
Yeah, of course. Hey, June, it could be worse. So,
Probably not.
so it's a good reason to stay inside and be working. And Hg seems to always be hard at work, given the business that you've built. So maybe there's good reason to be in London.
Thank you for coming anyway. Appreciate it.
Thanks for having me. So, first, I'd love to get into your background. You've had a fascinating career journey before Hg, at Hg, as the business has grown. So I'd love for you to start from the beginning.
So personal background very briefly. I grew up in a mining town about 100 miles north of London. Went to the local state school. Loved it at the time, really enjoyable. Didn't realize at the time that it would be slightly struggle to get from there to university. So I think about 5 or 6 as out my year got to university. So single digit percentages. And I was fortunate enough to be one of the nerdy kids that wanted to do that. Studied electronics and computer science at university. And then via a very circuitous route, I ended up in private equity straight out of university in 1990.
So you've talked about this before, that you've done engineering and you take an engineering mindset to investing, but you started your career really in investing. Do you think of yourself more as an investor or an engineer?
I think investor is definitely the word. So we definitely do not see myself, and I don't think we see ourselves as deal doers or people like that. I think we definitely think about ourselves as investors. I think we have applied a kind of engineering kind of mindset to what we do. And what does that translate into? I think it translates into trying to think about businesses very long term. What would this business be like over a kind of 15, 20, 30 year kind of horizon? And that's almost always the underlying kind of thinking we're doing before we make an investment or before we even go and look at a segment or a subsector that we're about to invest in. So there's definitely that kind of like logic that's been applied. And if you look at the senior partners in HG, the majority of partners here have got engineering backgrounds.
How do you go and break down both industries and businesses in that context, trying to think about the long term of both businesses and then more broadly the industries they're in?
I might be going to illustrate it. It's perhaps easier to start with an illustration. So we're pretty well known for investing, probably more than any firm on the planet, into accounting, bookkeeping, ERP. Makes us fascinating dinner guests, by the way. When we started looking at that sector, I guess initially we were looking at a particular business that was providing accounting software to small businesses. And perhaps the normal private equity way, particularly this is 20 plus years ago, back in 2003, 2004, the normal way that an investor might look at that would be, what are the revenues? What's the growth? What are the products doing? And of course, we look at that as part of our due diligence, but we tend to kind of take a much, much bigger step back and say, what are the underlying factors that are going to drive this business to grow or not over the next kind of 10, 15, 20 years? And to give you the quick highlights for that type of business, the number of small and medium-sized businesses, SMB customers, in almost every Western European economy grows at about 1% to 2% per annum. And again, you ask yourself, well, what are the fundamental reasons for that? And it's because large state-owned enterprises from the 50s, 60s, 70s have gradually broken down and they've gotten replaced by entrepreneurial small businesses. So we used to have, for example, a really, really terrible car manufacturing business in the UK called British Leyland that was nationally owned. We don't have that anymore because they made really terrible cars. And now the hundreds of thousands of people who used to work for British Leyland largely work in small and medium-sized entrepreneurial businesses in the Midlands. So 1% to 2% growth from SMB growth. But the most fundamental factor is about a 3-4% growth per annum in that market from essentially greater utilization of technology. And you ask why that's happening. It's because 20 or 30 years ago, small and medium-sized businesses didn't have a computer on their desk. As they got a computer on their desk and increased computing power, what could they use it to do? They could use it to have more software to do things in a more automated way. So the best illustration, I typically kind of pick up my mobile phone at this point, is, even 10 years ago, most small businesses had to do their expense reporting literally on a spreadsheet or on a piece of paper. Today, I guess we all click on the app, we all take a kind of photo with our camera, the taxi receipt gets automatically uploaded into our accounting practice package. And so that greater utilization of technology driven by greater computing power drives a market to grow at 3 or 4% per annum. You put those factors together, SMB growth, greater utilization of software, you got a sector that grows at about 6 to 7% per annum, which is kind of 2 to 3 times GDP, has done for the last 25 years, is doing today, will do for the next kind of 10 to 15 years. Well, that's a sector that's going to grow at 2 to 3 times GDP for 30 to 40 years. It's an interesting environment to start thinking about making investments.
So you've talked about platform shifts over the course of last 30, 40 years of technology investing, the most recent one being AI. So based on what you just said about the accounting industry growing faster than GDP, how does something like a platform shift such as AI impact how firms may end up interacting with software and may even be disrupted by software, or the companies themselves that are providing the software end up getting disrupted?
So first of all, kind of platform shifts tend to happen about every 15 to 20 years. So the ones we've had in a computing kind of paradigm have been obviously kind of mainframe, to personal computing to kind of web/mobile. And then now we think kind of AI is the next major platform shift. But they tend to last over a kind of 15, 20-year period. I may be completely wrong when I say this, because everybody tells me that AI is going to happen over a kind of 3-year period. It will be the first time in human history that that's happened. I suspect it will take a little bit longer. That's not to say there won't be dramatic changes in the next 2 or 3 years, but for that to pervade every part of business life, working life, social life, probably will take, a decade plus. But we do think it's a major shift. And just to kind of contrast that, you have interim technologies that are important, but end up not being major platform shifts. So everybody thought crypto might be one. Turns out it'll have many applications, but it probably isn't the same degree of ubiquitous platform shift. Everybody thought that, blockchain might be one, similar kind of issues. But we think this is a major, once in 15, once in 20-year platform shift. At the start of that, can you predict exactly how that's going to affect the existing incumbents? No. At the start of it, can you predict every startup business that's going to be super successful? No, you can't. Do we think it's going to have major repercussions for both, for startups and for incumbents? Definitely. And so you have to start to apply heuristics that suggest that if you follow the following routes, you'll have a chance of being successful. So if you're an existing business, number one, don't stick your head in the sand. Believe that this is going to be a very major change. What do you then do? You have to adopt these technologies as fast as you possibly can, initially internally within your business. So encourage everybody to kind of use them all the time, experiment with them, etc. And then from a new product perspective for your customers, I'd say experiment is like the number one word. You have to basically try lots of things because you can't predict exactly which thing is going to work for you. What you can predict is probably half the things you try won't work, but all that matters is 1 or 2 or 3 things that you've tried, new products that you've launched, start to get customer traction. So what we're doing with all of our companies is say, go experiment, go build things, go buy things, go joint venture, do acqui-hires, whatever it may be, but do multiple experiments to try and kind of make sure that you've got the applications of the future. Benefit that the incumbents have is they've got customers, they've got existing products, they've got existing processes, but they have to essentially disrupt themselves.
And on that point, that's a really interesting point, especially in the context of how you invest, which is investing in mission critical software, which purportedly would be the market leaders in many cases, particularly for the Saturn fund, which is the larger cap of the middle market and buyout space. On that point, how do you think about AI impacting those businesses that you're investing in? Do you worry about it disrupting them, or does that actually make those businesses even better?
So I think it's both. So again, I think if those businesses don't react and don't incorporate AI and don't launch AI products, they'll be disrupted because AI is going to be a platform shift. So they have to be prepared to take their existing products and disrupt them. Do they have some advantages in that change? Yeah, because they've got customers, they've got existing processes, those customers are satisfied with their products, etc. But if they ignore the changes or don't launch good products and don't execute well, likely they'll be disrupted. Conversely, a startup's got all the advantages of starting afresh, having no incumbency from the old kind of generation, being able to build in a very, very modern way. So they're like a speedboat, they can move super fast. But of course, they don't have customers and they don't have existing kind of processes they know. And typically where it gets harder for startups is with what I call the edge cases. So if you want to go build a small business bookkeeping application in AI, you can build something that's 90, 95% there pretty quickly and be very effective. The problem is whether you can do charity accounts for a particular type of charity in the UK, because I tell you that is a super complex edge case that even those people that have been doing accounting for kind of 10 or 15 years find difficult to get 100% right.
So do you think ripping and replacing a lot of these incumbent softwares, even with a platform shift like AI, will be a lot more challenging than it might seem?
Yeah, I think it will definitely be more challenging than it seems because it's all those edge cases that you have to satisfy. And those edge cases require not just great technology, but but they require really, really detailed knowledge. In the example I gave of, UK charitable accounting and accounting formats, and not every AI startup knows all those things right at the start. So that's not to say it's impossible. There'll be some great startups that are super successful. It's just to say that it's those kind of last 10 or 15% of product build out that is what really matters.
Well, I think on that point, there's a broader theme here, which is you're investing in these businesses that A, are so mission critical to the companies that use them, and B, they're able to serve all these different use cases or edge cases as well. There's something interesting about investing in mission critical software, which is that you can embed a lot of other products and services to that. How do you think about that?
It's the absolute kind of core of backing these businesses. So typically what you're looking to do is find a business that's got a really kind of core application for its end customer. It's really kind of the center of their world, and having that kind of record as part of their kind of software, a part of their database, is really critical to the end customer. And then typically if you kind of own that core record, what happens is you get the opportunity to sell lots of other kind of modules or systems around it. So if you take a typical kind of small and medium-sized business, there's really kind of two core systems of record. One is your general ledger, your accounting, receipts, payments, those kind of things. That's the absolute core. And then the second is kind of payroll. The people that work for you, what their skills and experiences and joining dates and leaving dates and holidays and all those kind of things are, and what that means in terms of you paying them. Because generally in a business, if you don't pay your people, they don't stick around too long. So they're the two core systems of record. But around those core systems of record, you've got lots of other modules to add. So if you take payroll as an example, you might have workforce management, you might have scheduling, you might have online expense reporting that we referred to earlier. There's typically about 10 to 15 applications that sit around that core system of record. And you as the kind of core provider have got about a 50% probability of the customers taking them from you if you do a good job. Now, if you do a terrible job and you have terrible products, then they won't buy them from you. But if you're the incumbent payroll provider, usually they'll come to you first, and you've got a shot at being able to give them that next module.
So you're an engineer. Let's keep going a mile deep.
We're really deep already.
Yes, which is great, because I think that, and I'm going to zoom back out and get to how big this investing opportunity is, because we're going deep, and this could seem like a pretty narrow area, but I also want to show how big and wide it is. But first, on the point of, as you think about just continuing to embed the products and services within the companies that you're working with and make it really hard to rip out, how do you think about creating value for a lot of the companies that you're working with? Is it generally encouraging them to build products organically and in-house? Is it through acquisitions and bolt-on strategies? What have you found that's generally been most successful, if there's been one way, and how do you kind of approach that when you underwrite?
I think number one for us starts with product. At the end of the day, your customers are buying a software product from you, and it may be an AI agentic product in the future, but your customers are buying a product, and what they want to know is that that product works super well all the time. They're going to get service if they don't know how to use the product, so you can help onboard them and help them learn how to use the product in an ongoing way. And then crucially, that you're going to innovate, and that product's going to have new features and new launches included in it, so they don't have to think about going elsewhere. It's a simple decision for them to think about what's the next upgrade to the tax calculations, which is really an insurance sell. They want to know you're going to get it right, but also what is the next module that you might want to add on. So for us, it all centers around kind of high quality products developed with modern engineering and providing customers with a kind of innovation path kind of going forward. That really is the kind of core decision. And for us, how do we build kind of product innovation and customer satisfaction with those products kind of into the investment thesis? Frankly, it starts with buying a good product, typically on day one, but it then also includes how we can develop engineering skills and product management skills and product innovation skills within that business. There's lots of other things a business has to do: selling, marketing, customer support, all those kind of things. But ultimately, this is the other point at which I hold up the iPhone. If Apple was still providing you with the iPhone 6, it doesn't matter how good the branding was and how good the packaging was and all the rest of it. It's an old piece of technology. So you have to kind of keep product innovation going.
So you talk about customer experience and product being at the core of what many of your companies focus on and do. Does it get hard then to integrate other businesses into that company because they may have a different product team, culture, engineering quality? Does that make it more difficult to create that and keep that same level of customer experience?
Yeah. So doing kind of like multiple kind of bolt-on acquisitions into a kind of software product business, you got to think super carefully about how you basically try and integrate those products over time. And there are different ways of thinking about it depending on the particular business we're talking about, but it's an absolutely kind of core consideration. So the easiest business to grow in some ways is a great product with a decent market size, and we're going to grow it organically. That's great. And where we can do that, that's what we'll choose to do. Often by also adding on one or two adjacencies. So that could be that we move the business geographically to grow it into different geographies. Could be that we've got some adjacencies in terms of customer segments. So we'll often try and go for those in terms of like next available opportunities for us to sell into. And then it could be sometimes that we're adding on modules. Again, if we can ideally add those modules on, grow them organically, developing them internally, we'll do that. If for whatever reason, either time-wise or technology-wise, that's not possible, then we might buy. But we've got to think super carefully about how we then integrate and link those products together. Thankfully, that gets easier over time, because APIs and integration is much easier than it was 10 years ago. So the tools and technologies are easier, but also because, as we develop things like agentic technology, those technologies actually help us to develop better products more easily that are more integratable as well.
You mentioned something in there about going to different regions. You're a firm with European heritage, obviously, that does a lot of work in North America as well. But some of the shining examples in your portfolio, let's take Visma as one example. You invested in, I think it was 2006, 19 years ago. It bought it for $450 million. It's now worth over 21 billion or so. I may be a year outdated at this point on that. But suffice to say, it's had a tremendous path as a business. That's been a business that has stayed in Europe. Do you think there's something about investing in Europe where businesses, because there's so many different jurisdictions, regions, cultures that you have to figure out how to navigate and sell into, mean that companies kind of do the hard things first, and then it prepares them to become bigger over time, and when they do, they're better for it?
I think it means that they have to think through kind of jurisdictional government, those kind of changes earlier in their life. So again, I'm not trying to make it sound like anything's easy in life. It isn't. But if you're in North America, and you want to take a single product, across boundaries, those boundaries are state boundaries. And sometimes there's slight differences, but essentially it's a single federal kind of unity. And it means that particularly in things like accounting or payroll and other areas that we focus on, you can actually build a single product that moves across, the whole of the US. 350 million people, broadly a similar kind of language, etc. You can build a 50, 100 million, 150 million kind of revenue business in a single product kind of like relatively easily. Market opportunities are bigger. If you start that same business in Germany or you start it in Norway, to get to 50 or 100 million revenue, almost inevitably you have to move across geographic boundaries. And in doing so, you have to develop skills around language and around governance and around tax and other regulations. So you have to deal with those things more early in your life. That makes things harder, which is why, frankly, there are more scaled businesses out of North America than there are out of Europe. But if you can cope with those things in Europe, it also gives you an extra degree of muscle and capability that will probably make your ability to grow long-term, maybe slightly better.
Interestingly, you've mentioned when you underwrite businesses, you tend to underwrite, I think you said, a forever hold, if not 10, 20 years plus when you think about what this business could be. And I think that's in part because of your engineering mindset of kind of really thinking about what does this look like over the long term, and it needs to be structurally sound at the beginning. When you think about underwriting businesses in Europe, how do you try to figure out if management teams understand and have the ability to expand beyond their own jurisdiction or culture?
So, sometimes that's important and sometimes it's not. So if I can just take a step back and compare and contrast the US again, It's partially about what's the scale of opportunity that's applicable for us in private equity. So if I'm going to continue with this like really, really dull example of kind of SMB accounting software, if you want to really play an SMB accounting software in the US, you can't really play that in private equity. There's one firm that is fantastic. It's called Intuit. Last time I looked, they're about $180 billion of market cap. I'd love to have a couple of $100 billion to buy them if our LPs would like to kind of provide that, because they're a great business. But absent that opportunity, frankly, you should just buy the stock, but it's not a private equity play. Those same types of business in Europe, we've got 27 countries. Each one of the countries has an Intuit equivalent. But obviously, because the countries are a lot smaller, that means the equivalent businesses are 2 billion, 3 billion, 5 billion, 10 billion enterprise value, exactly the right size for us to play in private equity. So whereas in the US, that opportunity is essentially pretty much non-existent, in Europe, it actually exists in 27 countries, and actually payroll is different to accounting. So we get the chance to play in 50 or 60 or 70 platforms, which is why we, HG, have played in dozens of platforms in that space in Europe. So I think you have to tailor that kind of investment strategy to the jurisdiction in which you sit. Back to the question on management, in a lot of cases, we said to management, don't try and expand outside your existing country. Payroll software in Germany is a brilliant place to build a multi-billion-dollar business. We have one called P&I, which is like the Visma equivalent in Germany. P&I was most recently valued at about 5 billion euros, $5.5 billion enterprise value. And that business is just playing in one product, payroll, in one segment, the mid-market in Germany, in one country. And yet you can build a very substantial, it's also a rule of 85 business. So a business kind of growing at 25% compound still, 25 years into its history.
So in some senses, there's actually a moat from having these different regulations, different jurisdictions, and different cultures that actually would make it harder for someone from the outside to come in to try to compete with P&I or another startup to be able to try to take market share in Germany.
Yeah, I want to make a bold statement, which I'm sure there'll be somebody kind of like contact you and I afterward to try and dispute this. I don't think it's ever in the entire history of human existence, in the entire history of the universe, has there been a payroll software player that's been brilliant in one country that has managed with the same product and the same platform to move it to another country. So when Visma moves across countries, it tends to acquire, because having a brilliant payroll product in Norway does not translate into that same product working brilliantly, even in Sweden, which is 100 miles away. So we much prefer to kind of buy the leader in Sweden and then work with them as entrepreneurs to be very Swedish and to be the best in Sweden, which does not mean the same as being the best in Norway. The two are slightly distinct.
Is that part of your strategy then as well, is to invest into the market leaders in different countries and maybe over time, at the very least, probably get shared knowledge that helps all of the collective portfolio companies, but then also potentially over time have some sort of a platform player roll-up strategy?
Yeah, it depends a little on the specific business and specific end market. In these markets that are very geographically distinct by regulation, that's exactly the strategy. We don't try and build one ubiquitous payroll product across the whole of Europe because it doesn't work. People have tried it, we've tried it, doesn't work, it's the wrong way. There can be other sectors where we've chosen to back a business that actually does have a product that translates across geographies. So if you're within a vertical and industry-specific application, you'll often find that the uses of that technology are not really driven by regulation, they're actually driven by technology for that particular end user. So if I was to pick a designer that was using a computer-aided design package in the automotive industry, actually it's the end automotive use cases that are more important than German tax regulation for him or her. And so actually that product would translate into moving across geographies, but actually within a particular industry. I wouldn't go and use that package then for a tax accountant because it's not very relevant. So I think it depends a little on the end application.
So we went a mile deep to kind of then zoom out. But I think a lot of what you just said in the past few discussion points really kind of capture what we're getting at, which is, if you think about it, mission critical enterprise software, people might think that's a mile deep sector space view of investing. But let's zoom out. How big is the enterprise software investable opportunity? Because you're a specialist. And I imagine that's when you talk to LPs, they say, okay, you're not investing in everything. How big is this opportunity?
So we have $100 billion of assets under management and growing at probably kind of 10 or 15% per year. One or two contemporaries in North America that are similar size as well. If you look at the number of companies, we're talking about like tens of thousands, if not hundreds of thousands of kind of companies that are investable. And, we have 53 in our portfolio. Our contemporaries have similar numbers. So we're talking about a very small fraction of the universe of available companies. And those companies are typically growing at many multiples of GDP. So it's also a growth market, both from the point of view of the end company's revenue growth, but also from the point of view of the number of companies available as well. So if I said to you, how many software companies or SaaS companies or AI companies were started in 2020 that will possibly be targets for us in 2030, given their scale, there were more started in 2020 than 2018. There are more in 2018 than 2016. So you've both got a growth market and you've got a growing number of targets as well.
I think that's a really interesting point because it feels like as software has become commonplace, every company is a software company in one way or another. And soon it may be the case that every company will be an AI company in one way or another, whether they may not be an AI company themselves, but they're using AI. How do you think about those concepts as it relates to what you just said about there's more and more investable opportunities?
So we think what we just said is precisely true. I mean, there's a great quote kind of 10 plus years ago from Mark Andreessen that said software is eating the world. And we think that's 100% true. There's almost no aspect of your daily life, any business daily life, where software is not used, every minute of the day. And that's pervading every single part of society, whether it's consumer, business to business, and it's every sector. And so it's a generic statement that is true. And we can see that from the growth of the industry. If we look very kind of specifically and say what parts of kind of our lives are now used in software, let's take straight behind you, there's a TV. Let's go back 10 years. The main cost of like consuming entertainment on TV was the hardware, the television. The cost of hardware and actually communications has been falling every single year. And yet you're still paying the same or more to consume entertainment. But how are you paying for it? I don't know how many subscriptions you've got.
Too many to count.
Too many subscriptions. Software and content is essentially the things that have grown. So the overall budget for kind of like TV entertainment in the consumer world has gone up year on year. Cost of hardware and comms has plummeted, and it's all about content and software. And it's the same in business.
Is that the same in business where companies will have more and more subscriptions, or do you think that they will end up consolidating that with a few key players in certain areas, and in particular the areas that you're investing in?
No, I think the number of subscriptions has just been going up year on year. Basically, that there is some consolidation within each particular kind of end application. But the bottom line is the number of new applications that you want, the number of things that you can do with software is just continuing to increase at a pace where I don't know how many subscriptions you have for your business. Like we last time I checked it out, I think we had like 90 plus, even for a relatively kind of modest private equity business. And if you're in a bank or a financial institution or a healthcare setting or an insurance company, I can guarantee that if you go talk to the CIO, you're going to have hundreds of software and content subscriptions.
I think that's a really important point when you think about where we are today, but then you look back and where you started. So I want to get to HG and where you started and why. You started in corporate, so I want to cover that and that evolution. But then also, I think the time that you were investing in technology, particularly enterprise software technology, is not as you describe it today.
Mm-hmm.
What were people saying when you were investing in enterprise software at that point in time?
Generally, our LPs were saying, don't do it. I remember back in, I think it was 03 or 04, we were kind of raising a fund, and I've been at HG kind of 3 or 4 years at the time. We've actually got a kind of caricature of this at some point, and the basic message coming from most LPs was, we really like what HG is, we really like your culture, we like what you're doing, just don't give the tech guy any money. This is kind of post-dot-com boom and bust, and clearly kind of tech was not in favor back in kind of like 02, 03, 04. And what we needed to do was frankly take our clients and take the market through the fact that, they'd just been scared by technology. They'd just seen a lot of hype and then, some disappointment. A lot of that tends to revolve around consumer technology because that's the thing that we all relate to, is the thing that we all see every day in our lives. And so, people were kind of like, paying for clicks, and people were paying for a lot of other things, the dot-com boom. And then, of course, some of that wasn't real. It disappeared and people got scared. But the things we were trying to do, because I personally had been investing in software for about a decade at the time, we'd understood that B2B software is very, very different to consumer. So business to business software is all about workflows and what people are doing day in, day out to make their lives easier in a business context, accounting, payroll, the kind of things we've been talking about. And those businesses are very, very different to consumer businesses. Most businesses buy their accounting software on a subscription. For most of them, it's like the most critical part of their kind of like daily usage systems they're using. It's the kind of thing that if it doesn't work pretty quickly, your business has got huge problems. And it's the kind of thing that you carry on paying for on subscriptions for many, many years into the future, because you're essentially typically buying what I call an insurance purchase. You want your accounting software to work every month, every quarter, every year with the right VAT, the right tax codes, the right way of paying the government, etc. And so you're not just buying a piece of software, a piece of tech. You're actually buying a service that has got to work day in, day out to collect your bills, to pay your bills, etc.
You mentioned things that are so critical to a business. In today's version of the internet, current wave, we see that. Back in 2004, yes, sure, there was mission critical software, but to put it in context, AOL was what people used. Steve was on the podcast at one point as well. And that was obviously the way people thought about the internet in many respects. Then, did you have the same view and conviction on B2B enterprise software as you do today in terms of how businesses interacted with the software they were using?
I'd say relatively early on. So like back in 96, 97, no. I was investing in some B2C, some B2B, some was mission critical, some wasn't mission critical. But that's the benefit of experience of the learning curve. Some of those investments worked, some of them didn't work quite so well. And so my investment strategy that ended up kind of influencing HG's investment strategy was really an accumulation of probably a decade's worth of experience from like 93 to probably 2003 through some B2C, some B2B, some things that worked and didn't. And gradually, as I got to kind of HG and was able to influence that strategy because I was more senior, I was able to say, look, there's plenty of things we could do here, but the things that probably suit us best are things that are highly predictable, very low volatility, have a very high chance of making decent returns. And by the way, there's kind of compromises you make with that strategy, because by doing so, we have to kind of avoid the chance that we'll ever make a 20, 30 times our money. So you have to very consciously say, I'm not a venture capitalist. I'm not trying to find the next Microsoft, the next Meta, the next Google. And in avoiding that, I have a low volatility and a higher predictability, but it means that I'll, never get my face on the front of the FT, which by the way would be exactly what I don't want. But you have to accept that you're never going to find the next kind of like, $20 billion, $50 billion business. That's not what you're after. What we're trying to do is to deliver, 2 to 4 times the money incredibly consistently with very low levels of volatility through every single market cycle. And highly predictable, sticky, mission critical B2B software delivers that, but it never delivers you the next Facebook.
I think that's a really important point to make, though, because A, you're a business yourself, one of your clients or LPs, and that's what you're selling them. You're selling them exactly what you said: low volatility, predictable, relatively predictable returns. I'd love for you to unpack that a little more, because I think that's so important. When you think about investing in technology, you don't always think about low volatility, predictable returns. Let's go a layer deeper on what that actually means in terms of how you think about your investment process to create that output.
First of all, being an engineer, I've got to give you the output first. So numbers speak. So Look, over 24, 25 years of doing this, we've delivered above 30% kind of gross IRR, above kind of 3 times the money across the entire kind of 25-year period. In doing so, we've had less than 1% kind of impaired capital or kind of loss rate. And I think, to be honest with you, the stat that's kind of most important is 91, 92% of our capital is returned 2 times the money or 20% plus IRR. So this is all about consistency. I think the highest return we've ever had has been like 8 times the money on one deal. It's about getting all these investments to deliver 2 to 4x, not the big multiples, but never losing money. Frankly, that's what it's all about. And so how do you do that? You start off with an investment kind of test, an investment philosophy that says, my go-to point is going to be, am I almost absolutely certain, 99% certain that I'm never going to lose money? I'm not looking at the upside on day one. It's like, am I almost certain I won't lose money? And the characteristics of the business I've described help you do that. These are businesses that grow revenues and profits every month, every quarter, every year for a decade. So if you look at our aggregate portfolio, 55 investments, they've literally, if we aggregate them up, they've never had a down month at all in the last 15 years. There's never been a single month, not in COVID, not in the GFC, where they had a down month ever on revenue or profitability. So that says, as long as I've bought them for a reasonable price, they're going to grow, and therefore I should be able to make some form of kind of profit on the investment. And then the next phase for us is, are we, say, 90% certain we can make 2 times the money? And that's about the work that, hundreds of people here are doing day in, day out to diligence a company and say, to make 2 times my money, I've probably got to be pretty certain I'm going to grow at 10 or 15% per year for the next 3 or 4 or 5 years. So how can we look at the existing base of business and be sure that's the case? So again, if you look at our portfolio, we have about 92, 93% recurring revenues every year. So even if we don't sign a single new customer, our existing customers, 92% will renew every year. And they typically renew with an increased value. They buy a new module, prices go up a little bit in the portfolio. So we typically have about 94, 95, 96% of revenues from existing customers every single year, which basically means if I don't sign a single new customer, I'm going to get about 94, 95% of last year's revenue this year, just by repeating from my existing customer base. That starts to put you in a pretty strong position to make 2 times your money, because you are going to sign some new customers with this big sales and marketing team we've got.
So from what you just said, I want to cover two words to start with a D. One is distributions. You've been very good in discipline, which is the other D I want to cover about doing that. But to unpack discipline, I think that's really a question on culture. Because if you think about what you just said, that you haven't had, I think you had no losses, and you've had this very consistent cadence of returns, distributions as well. It can be easy in the investing business to start to stretch a little bit, just culturally and naturally, right? You say, hey, I did this well. Maybe this one will work. Maybe let's go a little bit outside our box. What has created the level of discipline from a culture perspective at HG that's enabled you to have the run of performance that you've had?
I think it goes back, first of all, many of us here have been doing this for kind of 30 years. And so we probably had slightly less discipline in the 1990s. We probably tried a few different things. And we basically learned that, hitting your head against a brick wall is quite hard and stopped doing it. So when we tried things that were like slightly outside that periphery, yeah, they looked exciting. Yes, they looked interesting. But when you end up with a result that isn't as good, I think where the discipline probably counts is we were disciplined enough to kind of come back and say, let's evaluate how those kind of excursions have performed versus our core. And we were honest enough with ourselves to say they've just not performed as well on a risk-adjusted basis. And so over, roughly a decade of trying things in that experimental phase of kind of private equity in the 80s and 90s, we discovered that by having some discipline and having some focus, we could produce better results for our clients. And frankly, we could also leave ourselves with, a business that was more pleasurable to manage. When things go wrong, it's not exciting. It's not, good fun. It's miserable. It's like 10 times the amount of effort to fix an underperforming business as it is to kind of let a good business run. And so if you've been through those experiences, and, most of us here went through them in the 90s, you do try over time, to develop a strategy that allows you to have more successes and less things that go wrong. I think so that kind of experience, that learning curve we talked about earlier on, is super important. And it's something that we've tried to, whenever we've kind of gotten periods of the market that have been exciting, 06, 07, that was a boom period. 2020, 2021 was a boom period. I guess we've been in this market for 30 years, and we just try not to get too excited by those boom periods and keep our feet on the ground.
What do you do to keep the rest of the investment team, particularly younger investors who may have not had that same experience as you have, keep their excitement level high, but not to the point where they're going off and doing things that wouldn't be core to the way that you think and operate, and not do things outside the right strategy boxes?
Yeah, you wouldn't believe the amount of pressure we got to have a startup fund or a high growth fund, in kind of 2019, 2020, typically from some of the younger people within the team. And look, the bottom line is that would have just been the wrong answer. We know that some of our competitors launched those kind of funds, and frankly, now they're regretting it. Kind of cyber blow-ups and crypto blow-ups and these kind of things. I think it's a case of just sitting down with people and saying, look, all ideas are really worth debating. We never kind of discourage anybody from bringing ideas forward. We debate them really openly. So we had a really open discussion about these kind of things and said, we're not saying a growth fund is crazy. We're not saying a growth fund isn't something we might consider at some point in time, but think about the timing. Is, the 11th or 12th year of a bull run in 2019, 2020 likely to be the optimum time to launch a new growth product? History, we can go back to kind of 06, 07 when some firms launched them, regretted them. I can go back to some firms launching growth products in 98 and 99 and regretting them. So you could point out from history that frankly, we didn't know where the peak was going to be in 2021, but we did know we were like 11 or 12 years into a bull run. It's unlikely that that's going to be a good time to be launching that kind of product. So just taking people through those discussions, being respectful of the fact they're raising it, because of course, everybody's friend had made $1 trillion, in some startup enterprise the week before. So you've got to kind of listen to those things, but then take people through the experience and what history shows. And, we could show people that, we were taking their ideas appropriately, but it wasn't the right time for us.
The other thing that you've seemed to do really well is reflect and look at yourselves internally. I've heard from a number of people that you're so disciplined around knowing when to hold and knowing when to decide to sell a business. And I think that might stem in part from the realizations committee you have. I did a recent weekly post with theme to music and DJing, and I had some of the team at HG share some music choices. One of them was Man in the Mirror by Michael Jackson, in part because they described that they wanted to show that the firm really takes a look at themselves hard when making difficult decisions. I'd love to hear your perspective on how you think about taking the hard decisions, particularly when it comes to things like knowing when to exit a business, because that is so important. You could, as you say, you could hold a business for 20, 30 years, and you've done that in some cases like Visma, but then there might be cases where you have to sell, and having the realization committee maybe helps with that.
Yeah. Look, again, end output, we've been top 5% in the industry for DPI, kind of distributed capital versus paid in capital, for every fund, no exceptions, for the last kind of dozen years. How do we get there? It comes from exactly this kind of self-reflection that you talked about. So the underlying bedrock of that is something called a continuous improvement culture, which I know sounds a little bit trite. It's like Japan in the 80s, but it is really applying that kind of engineering type philosophy, which is if we can kind of look every year on a personal basis, on a team basis, on a firm basis, and say, what are the 2 or 3 things that we can improve? What are the 2 or 3 things we're not good at? And be honest about that, then you have the chance to kind of go fix them. It also creates this culture where people from, the most junior positions, the most, young people in the business are encouraged to speak up and tell their boss and tell me what we're not doing very well. And you have to kind of give them license to do that. If you cut them off or, don't encourage that, then you never hear about problems, which means, of course, you never fix problems. So it creates this kind of like open talking, frank kind of culture, which of course we have to work super hard to maintain as we grow larger. But that's really been one of the bedrocks, the kind of culture and the values within the firm. So getting back to DPI and kind of cash and realizations, we realized about a decade or so ago, maybe 14, 15 years ago, that one of the issues in the industry was you can have good overall numbers, but if you're not returning kind of cash to investors early, then essentially the IRR on a fund will degrade over a certain period of time. Long story short, when we did a bunch of research, we found that it was critical that you return about 1 times the fund's cash back in about a 5-year period. So 1x DPI. I'm going to ask you a question. Do you know what the average kind of period for a private equity fund to return 1 times its money is?
Say probably 7 to 9 years.
Yeah, 7.8. 7.8 years, the industry average. And if you do that in years 6 and 7 and 8, your IRR is degrading by about 3 or 4 points. So that's why private equity funds peak at year 4 or 5 and maybe a 30% IRR and end up at a kind of 20% IRR at the end. If you want to stop that degradation happening, you basically need to return all the cash in year 5 or before. And so we set ourselves that as a discipline to make that happen. One of the problems in the industry is you have an investment committee when you make investments to collectively make decisions about what's a good investment, but almost nobody has a realization or an exit committee to make good decisions about when you exit a business. And so we instituted a realization committee more than a decade ago to try and help each of our individual deal partners to make collective decisions on how we exit things better. And the long story short, the very, very quick answer is we basically try and exit the good but not great investments early in a fund's life to generate cash back to our investors and secure that IRR. And that allows us to keep our very best investments, the 20% that are going to go on to be 5 and 10 times the money type investments till later in the fund life.
Do you feel like by years 3, 4, and 5, when you're probably thinking about whether or not those companies end up in the exit planning bucket for that by that 5th year, that you can tell that those businesses are ones that you'd want to hold for 10, 20 years?
Yeah.
How?
Because we've owned them for kind of long enough to be able to kind of test that thesis again and again and again. It's something that, because we're always looking to see if something could be a kind of like secular long-term 10, 15-year hold, we try and test that on the way in, but it's impossible in our experience to actually fully know that on the way into an investment. But when we've been investing in the business for kind of like 3, 4, 5 years, we find it's possible certainly to believe that we can hold it for another 4 or 5. We never sit there on year 3 and say we can hold this business for 17 more years to year 20. We think it's a kind of rolling 3 to 5 year assessment.
That was going to get to my next question, which is how often do you re-underwrite these businesses, which I think is even more important as you think about the different structures you have. You have the Fusion Fund, you have the trust. So you have these other types of vehicles in addition to closed ends. Does that kind of guide a cadence for how often you re-underwrite each of these businesses so that you decide which ones you want to hold and which ones you want to fold?
Yeah, it's about every 3 or 4 years. So every 3 or 4 years, we're looking ahead and saying, can we see ourselves holding this business for another decade, which means we'll definitely commit for another 5 years, and then we'll put another test in 3 or 4 years' time to see if the second half of that decade is something we want to continue to go for. But basically every kind of 3, 4 years, we're essentially kind of re-underwriting. The really crucial part about that re-underwrite is it's not just a kind of passive BAU, oh yeah, we'll just continue rolling forward. We tend to build an entirely new kind of value creation plan. And I think what's really surprised us for businesses that we've known well, we've been invested in for a decade, like Visma or Iris or P&I, IFS increasingly, it's not only that we want to continue to hold that business because the fundamentals remain attractive, but the value creation we're going to apply in that next 3 to 5 year period has been radically different to even the previous 3 to 5 years. So if you take Visma, currently Visma is all about global expansion not just in Europe, but well outside Europe. If you take Visma back in 2010, our investment thesis was entirely about product and technology and converting the business from being on-prem to being truly modern SaaS. They're radically different strategies. One is all about technology and product and engineering. The other one is all about geographical knowledge and retaining entrepreneurs in new countries that you've never been into before. So one is about org structure and culture, and the other is all about engineering. Very different.
Those are totally different underwrites. So it's almost like you're underwriting a new business and a new business case with the benefit of knowing the business and knowing what works and what doesn't.
Absolutely.
We talked about AI, but I want to ask about AI in the context of this question. Is applying AI to these businesses that you've invested in, is that now a big part of these re-underwrites that you're doing and almost thinking of them as new businesses?
Yeah, huge. Yeah, so we're absolutely convinced that AI is going to give us huge productivity benefits in these businesses. So, I mean, again, I'm going to make for the first time in human history comment, but for the first time in human history, the cost of developing software is getting cheaper, not more expensive. That's never been true at any point until about a year ago, ever. And with AI, you can now develop software products, faster, more efficiently, more cheaply than ever before. With AI, you can actually provide customer support, customer service cheaper and better than ever before. So the kind of costs within a software business that are largely customer support and product development are getting cheaper and more productive. On the flip side is what we discussed before, which is the revenues you're going to get from customers will come from different types of products and different types of sources. So we think if you manage to kind of get a business that is properly kind of agentic AI in the next 4, 5, 6 years, you have an opportunity to capture a much greater market opportunity, much greater revenues than you had in the old world. But equally, if you don't develop that product and your competitor does or a startup does, then clearly you're under threat more than you were before.
You mentioned the rule of 85 with P&I. The general gold standard for many SaaS businesses is rule of 40. So a combination of growth plus margin, rule of 40. Does AI take the rule of 40 to the rule of 50 or 60?
Yeah, I mean, we're only running at rule of 50 plus in our businesses. So I think it will take it up, and it will probably take it up by a kind of factor of 5 or 10 points.
On that point, do you think if you're putting an LP hat on, will LPs do better investing in, through funds, businesses that are investing in funds that are already investing in good businesses that become better from AI, or investing in startups? When you think about the risk-adjusted return for investors, is this private equity's time to really invest in software because you're taking a good business, Visma, profitable, P&I, profitable, et cetera, and making it better with AI?
I'm going to rephrase it slightly, which is I think you can invest in both ways. So I think you can back great venture capitalists that will do great by backing AI startups. And I think you can back great private equity buyout software investors. They're going to be able to adapt their existing businesses to be AI native. It's all about backing the best players in those industries. So, we're making kind of 30% plus returns over the last 25 years with very low levels of volatility. That's right up there and comparable with the very best venture capitalists. But equally, the very best venture capitalists are doing those returns as well. The secret is to be backing the very, very best players doing each of those things and not to be backing the average player. The average private equity player doing software buyouts is going to struggle with how to deal with AI.
I think that's a really good segue to HG as a business. So you've grown the business. We've talked about software businesses being great businesses. You could argue that the business of asset management is as good or better than SaaS. There's a lot of similar features. So I want to start with, the firm has now grown to over 100 billion of AUM. How have you thought about growing the firm as you think about investing in your own business?
So the way we've chosen to grow our business is, I guess, first of all, to think about the overall private equity industry. And it was pretty obvious, back in the kind of 80s and 90s, you had like the first gen of private equity, cottage industry that was starting to develop, starting to become more mature. It was pretty obvious to us that the leading players in the industry would be kind of multi-asset alternative managers. And we all know who those very, very big brand names are. And we at HG had to decide, 20 years ago, were we likely, as what was a mid-market European player at the time, were we likely to be able to catch them up? and compete with them head on and be one of the top 2 or 3 firms globally. And we said, we are unlikely to be able to do that. They were already well ahead. And frankly, we as kind of individual partners probably didn't have some of the managerial skills either. You have to know your own limitations. And so we concluded that we had to develop a different strategy. And particularly as an industry gets to the second and third generation, what typically happens is it consolidates. The big get bigger. If you're a tiny kind of niche firm, you're okay. And in the middle, you end up being threatened by people on both sides. And we were likely to be, let's call it the top end of the middle at 100 billion. So we were a scale player, but we had to have a strategy that wasn't replicating what the very, very big guys did. And our strategy is pretty simple. We had to be the absolute best at what we did. We had to be the absolute premium, by which I mean returns to clients at low volatility. So we had to be, if you want to use analogies from other industries, we had to be the Ferrari or the Porsche of our industry, or the Hermes of our industry, or the Patek Philippe of our industry. And that's our chosen strategy. We want to deliver returns that are 10% plus better than those industry kind of names that are bellwethers.
So as more capital comes into private markets, the big players, like you say, get bigger. I imagine they'll continue to encroach on your space a bit and maybe bid things up. There's more capital flowing into the space. How does that impact how you invest and how you maintain that gold standard brand, like you say, and still generate the types of returns that you want to for investors, but also balance it with the fact that maybe there's bigger pools of capital coming in, they're going after bigger deals that you may be going for as well, but have to decide whether or not you want to do them?
I'm going to use those same analogies. It's Patek Philippe, it's Ferrari, it's kind of Hermes. You know, in each of those industries, there's plenty of people make cars that have got a lot more capital than Ferrari. There's plenty of people make watches that have got a lot more capital than Patek Philippe. Plenty of people that make handbags that have a lot more capital and other things than Hermes. And what those firms have done is chosen to kind of specialize and to be super, super, super highly skilled at the things they chose to do. And to do that on a global branded scale. Each of those businesses is not just selling Ferraris in Italy. They sell Ferraris globally. They sell Hermes handbags globally. So they've chosen to be global scale businesses, but doing a small number of things incredibly well. And that's exactly what we're doing. So we're not just in investing, we're in tech investing. We're not just in tech investing, we're in software investing. We're not just in software investing, we're in B2B back office software investing. We're not just in B2B back office software investing, we're in B2B back office software investing that is SaaS, that is going to generic AI, and in due course is only going to be focused on 5 or 6 or 7 core clusters. So even within this thing called software, we're already in a segment of a segment. That segment, by the way, is, you know, hundreds of billions. So we can still build a very scaled business globally by being in that one segment. And we're applying all of our resources just to that one individual focused market area. So we have 400 people. We have 70 people in our portfolio operations group. We have 200 people in our investment teams. If you look at what some of the very largest players in our industry would have to do, they'd have to put half or more of their entire global private equity teams and more than half of their operations team, cancel every other sector they're investing in and cancel every other geography and put all of that onto one thing, which is B2B, back office recurring revenue software in our clusters. Nobody's going to make that decision. They just don't have the scale. So even though these players are large on a global basis across multi-assets, etc., in what we do, we're the largest player globally. We're the most significant player globally. We've been doing it for 20 years longer than anybody else. And we've accumulated an amount of experience in doing that one thing really, really well that enables us to be like a Patek or like a kind of Ferrari or like an Hermes.
That was a great depiction of going a mile deep. You just peeled off all the layers of everything you do. But I thought that was such a great way to describe what you do. I want to ask a similar question, but on a different angle, which is taking it one layer deeper. As you think about your firm, you've separated out lower mid-market, and upper end of the mid-market with separate funds. Some firms would have a single fund across different strategies within an investing category. Why separate out each distinct part of the middle market into separate funds?
So each of those funds has got an identical investment strategy. They're all trying to do exactly the same type of B2B back office recurring revenue software in certain verticals, identical. The only difference between the funds is scale. So our Mercury fund is doing smaller investments. Our Genesis fund, where we started, is doing mid-cap investments. And our Saturn fund is doing larger cap investments, but with exactly the same software investment strategy. To be honest with you, the only reason we separated them out was that for us, it's a little easier to manage that way. We think it's perfectly valid that some people would choose to put them all into a single fund. We just found it more difficult to say to a partner, you're going to be in the single fund and you've got to choose to spend your time doing X. It was easier for us to say, we'll pick these following partners and following kind of executives to focus on the smaller end and make it incredibly clear what their job is. And yeah, generally it gives us the option to say to people, which of those types of investment would you prefer? Some people really prefer just dealing with slightly smaller businesses where they're directly dealing with founders often and dealing with kind of founders that are trying to make a transition into a slightly larger business. Other people prefer dealing with larger global scale businesses that are already kind of professionalized with professional management teams. So it just allows us to kind of help our executives choose what they want to do.
You did a great job of describing why you orient the firm from an investment perspective in that way and why that might help people shine investment side. You've also, as a scaled player, decided to move into the wealth channel. I'd love to hear why you've done that and also how you've done that. You have a fund, the Fusion Fund, which provides access to everything. So would love to unpack all of that because I think that's an interesting evolution in many firms, businesses in this space, and you're no exception to that.
So we've been super fortunate, to be honest with you, that completely by serendipity, we had what's called a listed investment trust, and we've had it for kind of 25 years. It was tiny 20 years ago. Today it's kind of larger, kind of multiple billions, listed on the London Stock Exchange, called HG Capital Trust. So we've always served what you might call the kind of retail or the wealth channel. Literally, if you have, I think it's around about £5 today, you can go and buy a single share. And then you get access to all of HG's investments. I've also got to do an advert. It's the best performing investment trust, pretty much bar none, for the last kind of 20 years, 17% compound over that period, net of fees, etc. So it's performed well. People can see that track record over time. At the other end of the spectrum, we obviously had the institutional limited partner funds. And they're obviously a kind of institutional product where you have complex legal documents and drawdowns and all those kind of things. What we recognized as the industry has moved was that there was a product probably that sits in between those two. There was an open-ended fund that wasn't just a purely kind of listed closed-end vehicle. It was an open-ended fund that would give people some of the attractions of an immediate subscription, so no drawdowns, no complex legal documents, or will give them within some restrictions possible liquidity on a kind of quarterly basis. So we launched HG Fusion to essentially sit between and fuse those two models. It sits between the kind of institutional capital model and the pure retail kind of HG Trust model.
What do you think you learned from having HG Trust in the market for so long that's helped you navigate the build out of Fusion Fund and apply some of those lessons learned?
I think it's all about education. You know, private equity kind of comes with lots of different kind of like flavors in the media, generally not positive. It comes with lots of kind of like quotes and history of, you know, asset stripping and, you know, sacking people and kind of cost reduction. And that's not what we do at all. It's not what we've done for the last 20, 25 years. We've grown businesses, created employment, you know, grown revenues and profits. And so I think what we learned very early on with HG Trust was that we've got to be able to communicate what we're doing. We've got to be able to tell people why we're not doing super risky, highly volatile startups, because we're not. Why we're not cost cutting. We're actually growing businesses to generate a return, because that's what we do. So HG Trust has meant that we've had to kind of communicate with a much broader audience. If you're doing that with an LP, you know, that is providing you with hundreds of millions of dollars, it's obviously super easy to do that one-to-one, as we're doing now. If you're trying to communicate with somebody that's bought, you know, 3 shares of HG Trust and spent £15, you have to communicate in a slightly different way. And so it's encouraged us to try and communicate, you know, in a more mass market way to a consumer that is used to making slightly different decisions and in a very different way to the way we communicate with some of our biggest LPs.
How has that influenced how you've thought about your brand?
Again, we think, you know, brand is super important in this newer world of kind of wealth and wealth management. And all the things that we've been discussing today, I think are about how we're trying to kind of build and communicate our brand. It's about dependency. It's about consistency. It's about transparency of what we do and how we do it. It's about people having kind of confidence that we're going to deliver regular returns through any market cycle. It's about a kind of sleep at night type investment strategy. These are all things that if you're communicating to kind of people that are less familiar with private equity, are super important things for them to kind of understand, because this is an esoteric, complex, different world. And so to be able to illustrate those pretty simple concepts, dependency, consistency, lack of volatility, through every way in which we communicate, is super important.
It is a complex world, but interestingly, and especially when you think about the end consumer, is they may actually touch some of the software that you're investing in. This is mission critical software. They might be a small business owner, or they might be a customer of the company that uses that small business. Is there a way to connect those dots, or that you've tried to connect those dots to help people understand just how pervasive private markets actually are in the world, even if they don't necessarily see it?
Yeah, that's what we're trying to do. It's slightly more difficult because we don't do consumer software. So if I said, we did a software that, runs your Apple Watch or something, then it might be more obvious. So we have to take those analogies of, the software we run. Imagine the local plumber that's either, your business because you are a plumber, or they just come to your house. They have 10 or 15 people working for them, in Romford in Essex. That plumber trying to run a payroll has 2 or 3 options. They can try and do it all themselves off of paper. Very bad idea. They can outsource it to their accountant, and we provide the software to enable their accountant to do that. Or they can use a software package and have a bookkeeper to kind of help them kind of run the payroll. What's super important for that plumber is the consistency of that software working day in, day out. They don't want it to be the most sexy, the best UI, etc. What they want is that it's right every month, always on time. Because the problem for them, they pay maybe £1,000 a year to subscribe for that software. So it's not large in the kind of context of a plumbing business of 10 or 20 people. But if it goes wrong, what's their pain point? Their pain point isn't, I've got a call center to call. Their pain point is they've got 19 plumbers on their driveway on a Sunday morning that want their money. That's what happens if payroll software for a small plumbing business goes wrong. So what they're buying is consistency and reliability. And that's what our software is delivering, whether it's in plumbing, whether it's in an electrician, whether it's somebody who's running a small software business that's doing payroll.
I want to connect this is related to so many people's lives, to the more structural aspects of private markets, which you think in the US, 87% of companies that have 100 million in revenue or greater are actually private. I think it's a even greater statistic here in the UK. I think it's north of 90+%, and same in Europe. How do you think the structural elements of private markets continue to play out? Will private companies continue to stay private longer? And what does that mean? Let's connect it to the end investor in terms of being able to access growth through investments.
I mean, I think those stats are exactly right in the US, and it's more than 90% of businesses are private in Europe. I mean, it's pretty simple. If you're an investor that doesn't touch private markets, you're missing out on 90% of the available opportunities. And often, if you look at the growth of those businesses, our portfolio is 55 businesses. It's in aggregate 180 billion of enterprise value, but it grows revenues at 13-14% per annum. It grows profits at 19-20% per annum. If we listed that business, it would be in the top 5% of growth businesses on the stock market. And yet investors have no way of accessing that other than via us. They can buy HG Trust shares, they can come into HG Fusion. So I think, and what is true for us is obviously true for many of our contemporaries in different sectors as well. I just think it's a part of the market that most investors over time will want to access because it provides them additional opportunities to buy into growth businesses.
I want to touch on one other aspect of working with the wealth channel, which is the fact that as a business yourself, you're privately owned, you're owned by the partners. What does that mean in terms of how you think about building the wealth business?
For us, it's super simple, and it's not just the wealth business, it's every part of our business, which is we're private, we have no intentions to kind of sell a stake to anybody or ever go public. Our public contemporaries are driven essentially by consistency of earnings, which really means consistency of fee income. And therefore, they're incentivized to launch more and more products that have more and more fees. That's just a fact. We're not incentivized by that. Basically, we're incentivized by carried interest, and carried interest essentially relates directly to the profits that we make for our investors. So our form of ownership kind of is the most pure form of aligning our investor interests with our own interests within our business.
It is, but then the challenge, I imagine, would be that you have to compete with firms that are investing heavily into some of these initiatives to grow their own business. How do you then think about the investment required to grow your business, whether it's the investment side, whether it's on the wealth side, whether it's on the operations firm level perspective?
So again, back to our kind of ownership structure, we can make those choices. We don't have any other investor that is compelling us to deliver them profits every year or a certain growth in profits or a certain level of profits. So if we see an opportunity to grow our business, and thankfully we've seen plenty of opportunities to grow our business over the last 25 years, we have the option as individuals that own the firm to make the decision to either kind of take those profits out to pay ourselves or to reinvest those profits in the business. And we've very consistently for the last 20 plus years chosen to reinvest the profits that we could take out of our business into growth opportunities. So, growing from the UK into Europe 15, 20 years ago was an investment decision. Growing from Europe into the US 10 years ago was an investment decision. Growing into HG Fusion to provide, another wealth opportunity was an investment decision. And every time we've been faced with those, we've been very fortunate that we're in an industry where there's a good return for those investments if you take a kind of 3 or 5 or 7 year view. And so none of those investments have got instant payback, but they've all got very good payback if you take a kind of decent long-term horizon. So we try and apply that almost forever horizon that we talked about for our investments to our own business as well. And we're prepared to reinvest profits and cash flow for what should be good business opportunities, 5, 7, 10 years down the line.
I want to talk about that forever investment horizon mindset. We kind of started there, and you talked about this, having that perspective when you underwrite a business that you invest in. And then we talked about it in the context of HG growing from where it started to where it is today at over 100 billion of assets. How do you think about the next 20 years of HG? When you think about, we're re-underwriting this business today, what do you think HG looks like 10, 20 years down the line?
We think we've got similar kind of growth opportunities kind of going forwards. And it all starts from the fact that, the two factors that could influence our business. So one is the private equity marketplace. And we've just been talking about, we think, kind of public access, whether that's retail or high net worth or ultra high net worth, is probably going to continue supplying capital that grows at, you tell me, but probably of the order of double digits to our industry for the next kind of decade or more, along with continued investment by typically kind of geographies where private markets have been under a standard percentage, and those markets are going to grow, be that the Middle East or Asia or other kind of other continents. So the combination of those two, both institutional growth and private market growth, I think provides probably double-digit growth to the private equity industry for the next kind of decade or more. If you then look at the flip side and say, what about the end markets that we're investing in? We talked before about the fact that software is growing at around about 3 to 4 times GDP, has done for the last 20 years, is doing today. AI will probably only enhance that, but it will maintain it. So we've got both the supply side and the opportunity side that are growing at 3 or 4 times GDP for secular reasons that we don't see ending, at least for the next decade. I'm not sure I can entirely predict 25 years out, but certainly for kind of 10 to 15 years, we think we've got those underlying secular factors. So we're willing to make a bet that that's something that's worth investing in and rolling the dice forward for the next kind of 10, 15, 20 years.
What I love about that answer is you said the same exact investment case for P&I or Avisma earlier, and you just said the same thing for HG, the business, in terms of how to think about the opportunity set, the growth of both the industry and the business. I think it's such a great encapsulation of both HG, and then if we zoom out, just the opportunity to invest in software and enterprise technology. I love ending this podcast by asking everyone what their favorite or most interesting private markets investment is, but I think so much is happening now. I'd love to see what your perspective is on the forward of that. So, looking forward, what is your favorite or most interesting private markets investment right now?
I mean, I think it's going to be an AI. I mean, I know that's a very, very generic and, kind of like obvious answer, but I think it is moving at such a pace and it's providing such kind of productivity benefits that I think the things you're going to be able to do with technology 3 years, 5 years from now, are going to eclipse anything we've done the last kind of like 15 to 20 years. As I said, I mean, the most, I always look for kind of like inflection points in things. And the huge inflection point is that every single year, in human history so far, software development has been more expensive and more complex and more difficult to do. And for the first time ever, software development, building products is getting easier and faster. So we're able to kind of launch more products, more innovation for our customers. That's unique.
What will that mean for humans in the workforce?
I think it's a really good question. And I don't have an immediately, obvious kind of answer. I think there will be short-term disruption in certain industries for certain people. I am a big believer that over time, every time we've had a kind of technological innovation, it's certainly caused short-term disruption, and that's got to be considered very, very carefully. But over the kind of medium term, it's produced massive benefits for humankind. So again, let's use the analogy, people kind of like drawing, plows manually or with horses, were disrupted when kind of mechanization came along, but human lifespan in agriculture doubled when that could have happened. And so those people that were dying at the age of 36 from broken backs, are probably glad they're not having to do that today. So I think there will be productivity benefits and net it will be good for society. We do have to think really carefully about short-term kind of potential disruptions.
Do you think executives and employees will need different skill sets now that AI can fill gaps that otherwise couldn't have been filled by technology?
Yeah. If you're not using Claude and Anthropic and, OpenAI right now and spending a day or a month or, an hour a day yourself, whoever you are in business, whether you're a chief executive or whether you're kind of like a developer, whether you're an investment executive here, if you're not doing that day in, day out, you're behind.
What's the skill set that will be required to use that well? Is it prompting it in the right way, or is it just using it?
I think it's prompting probably, but again, these things are developing, and so I'm not going to predict exactly what skill it is 3, 4, 5 years from now. The main skill I think to use is just go experiment, try it out, and as the obvious skill becomes more obvious, you'll be able to adapt to it because you're only 10% away from it. But if you stick your head in the sand, don't try it, you're scared of it now, when it becomes obvious kind of how you have to use it in a year or 2 or 3 years' time, the catch-up factor is going to be huge, and people get scared of those things. So it's very obvious human nature is to be a little bit afraid, to not want to ask the question, you're afraid of looking stupid. But if you dive in now, we're all stupid. None of us really know what we're doing at this point in time. And so dive in, experiment, be prepared to ask questions, and then you'll kind of keep up with whatever the right kind of phase of development will be.
What would you tell both young people who have their careers ahead of them and older people about what to learn or study in the age of AI?
I'm going to take a slightly more generic step back. I'd encourage everybody to think quite carefully about industries that are likely to be growth over the kind of medium term. So the best analogy I can use is, I grew up in a mining town, and I always tell my kids, like, I could be the Lionel Messi of mining and I wouldn't have a job because there is no mining left in the UK. There was lots of mining when I was growing up in the 70s and 80s. You can be a very average software investor for the last 25 years and you do okay. So picking something that is secularly growing and thinking about that quite deeply is really, really important. So obvious things, aging population, healthcare, genome sequencing, these are all things that are likely to benefit society over the kind of medium term. They're all growth areas. They're all areas where AI and technology is going to have an application to going to help us do things better. and they're not things that are finite. Once we've solved cancer, which I don't think is going to happen next week, we've got Alzheimer's, we've got degenerative diseases, and a whole bunch of other things to try and solve as well. So some mix of kind of technology and kind of healthcare feels to me like you're putting yourself in a place that gives you a good shot at a growth market for the next 20 to 30 years.
I think that's a great way to end this, looking forward, but also mentioning Lionel Messi, because I think that there's a lot of similarities in terms of the way he sees around corners, the way that you all have seen around corners, so focused and so precise with everything. And you've done a great encapsulation of what you've built at HG, but also what you've done as a firm. So
that's very, very generous. Thanks very much indeed.
Thanks for coming on the show.
Cheers.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going